Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the tax and offshore reporting basics for visa holders such as H-1B, L-1, O-1, E-2, E-3, EB-5 investment, B-1, B-2 tourist visa. So it's common for someone who's a U.S. citizen, of course, to know they have an income tax and reporting requirement. It's a little less common for legal permanent residents or green card holders, depending on how long they've been in the U.S., even outside of the U.S. But visa holders kind of get it the worst because a visa holder is not always treated as a U.S. person. A visa holder is only treated as a U.S. person in a year they meet the substantial presence test. So the substantial presence test is a complicated test. It's split over 3 years at a 1-to-1 ratio in the current year, 1-to-3 ratio in the prior year, 1-to-6 ratio in 2 years back. And basically, when you total up the computation, if the visa holder or even non-visa holder foreign national is in the U.S. for a total of 182 days, then they become subject to U.S. tax and worldwide reporting on their global income and assets. If you break it down, it's about, I think it's 121 days per year. If you do the calculation, you would get there. So that's not that long, maybe 4 months a year, a little more. The U.S. income tax rules are different than most countries. The U.S. files what's called the CBT, citizen-based taxation. It's a misnomer because it includes permanent residents, and it also includes visa holders who meet the substantial presence test. The U.S. taxes you on your worldwide income when you met the substantial presence test. So what that means is the income you earn in the United States, the income that you earned overseas, assets you have overseas have to start to be reported. Instead of filing a 1040-NR for non-resident, you would file a 1040 as if you were a U.S. citizen or green card holder. It includes all types of worldwide income, earned income, investment income. It doesn't matter if you lived in that country or not. At the end of the day, when you meet the substantial presence test, you're a visa holder, unless you're not subject to it like an F1 visa, student visa in the first 5 years, you become subject to this worldwide income requirement, which is ridiculous. Presumably, you probably wouldn't qualify for the foreign earned income exclusion because you're living in the U.S. for a significant amount of time, but depending on how you set up your days, you may be able to qualify for a bona fide residence test or physical presence test, just depending on how you do it. But the IRS is very strict with that. Under the foreign earned income exclusion, you can exclude up to about $105,000 of your foreign income from tax in the U.S. There's also a housing exclusion. In addition, if you've already paid tax in a foreign jurisdiction, you can generally take what's called the foreign tax credit. Foreign earned income exclusion is on Form 2555. Foreign tax credit is on Form 1116. In addition to the worldwide income, what's even a bigger hassle for most people is the worldwide reporting. There's a ton of different international information returns that need to be submitted based on what your foreign assets look like. Trusts, accounts, assets, corporations, entities. It's not only for fat cats or bigwigs. The most common form is the FBAR, Foreign Bank Account Reporting, otherwise known as Foreign Bank and Financial Account Reporting. The threshold for that is $10,000. So if you're in a country with a strong currency, and the pound is at 0.6, it's $7,000, $6,000 and in pounds, and you have an FBAR reporting requirement. In addition, there's FATCA. FATCA is the Foreign Account Tax Compliance Act. The threshold's a little higher for that. That form is filed directly with your tax return, your 1040, not your 1040-NR. And that's the bummer about meeting the substantial presence test. If you are non-compliant in prior years, the IRS has developed certain ways for you to get into compliance. If you had no idea there was anything you were supposed to do, generally you wouldn't go with the first option, which is traditional voluntary disclosure, which is for people who cannot certify under penalty of perjury that they were non-willful. If you recently learned about it, it's only been a few years, you didn't know, generally something like the streamlined domestic offshore procedures, streamlined foreign offshore procedures. There are some other programs available, delinquent international information return submission procedures, and that's a mouthful, right? and delinquent FBAR submission procedures as well. Those are a little less stringent than the streamlined programs. Then there's always a reasonable cause. There's a lot of information to sift through. We have a lot of free information on our website, goldinglawyers.com. We have an international tax law blog we try to update as much as possible. We have a sister website, irsstreamlinedprocedures.com, specifically for helping inform people and navigate through the streamlined program. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.